All right, so NASDAQ, this is our daily chart here. Take your attention up to this old high here. So that is a key level, 12,339 even. Then the consequent encroachment of that wick, because wicks are gaps. Some of you are asking, what do I mean by a wick as a gap? The algorithm refers to a wick as a gap. And the gap will want to most likely be treated to its consequent encroachment, which is the midpoint of the gap. Not to be confused with a mean threshold, which is the middle or 50% level of an order block. Okay, so my order block theory and gap theory are distinct. They're very similar in some ways, but they're very different in others. All right, and over here we have two down closed candles, which is the bullish order block. If you look at the candle's high here to this candle's low, that's a buy side imbalance, sell side inefficiency. Fair value gap, but specifically categorized as a BISI, buy side imbalance, sell side inefficiency. The market trades down into it here and trades into the order block, the open to the high. So both of those levels here. Be mindful that this blue shaded area is this imbalance from here to here on this single candle. And the order block are these two heavy blue lines, okay? So it looks like we traded down here, picked up a discount, pulled off the low, and we'll probably look to trade up into this level here, 12,149 even, tomorrow going into Friday. All right, so here we are on the hourly chart, and right away your eye should go right to this clean level here, relative equal lows, and here's that daily buy side imbalance, sell side inefficiency right here, this blue shaded area. But it's aimed at this range from here to here. That's what it's showing. The order block high in the open on the daily chart, that's what these levels are here. So you can see how we ran up, took out the short-term high, broke lower. We have a high, low, higher high. Down closed candle is what? Bearish breaker. Trades below it, comes back up, bumps it, sell off. Does. Sells all the way off to take out the sell side liquidity. And there's an imbalance here and an imbalance in here. And we're going to take a closer look at both of those. Right, here's the 15-minute time frame. You can see the sell side liquidity pool here. Too clean. Jagged edges are the result. Smooth edges like to be made what? Jagged. Okay. Fair value gap here. Market trades down into that. Comes back up. Finds the support. Rallies through the short-term high. Trades up into the imbalance here. And this high, while it is a nice breaker, it actually has multiple breakers in it. We have the high, the low, the high, and this down closed candle. Project it forward. That's the reaction I showed you before we dropped down from the 60-minute chart to the 15-minute chart here. That was the reaction we saw dropping. But there is another breaker with high, low, higher high, just as well as you can use this here. High, lower, higher than this. The down closed candle, you project that forward. We traded into that. Okay, we went above a little bit here, above this candle's high, right there. So I'm watching to see, do we disrespect this SIBI? Okay, because this actually is a balanced price range. And it needs to get through that. Now, should we get through all of this range in here and trade aggressively above that, then the levels I mentioned on the daily chart are within reason. Otherwise, we could chop around. I don't see a sell-off here yet. Like, I don't expect a big dramatic sell-off because we had pretty much that, overnight on the 24th, which I outlined real time, showing you in the charts. We're actually within under two handles from the very high of the daily chart, making this rotation lower. When I was referring to ES, not the NASDAQ, by the way, but nonetheless, it's the same thing. All right, so here's the 15-minute time frame with the imbalance here. So we have sell side and the fair value gap. So it digs down into that, and it's also the low end of what? The sensitive price point of a bullish order block, which is the opening price, and the high. So it trades down into it, hits it, and then reacts. So let's take a closer look inside this area in here. All right, dropping down to a 2-minute chart. We have buy side here, smooth relative equal highs, smooth relative equal highs, breaks, order block, trades back to it here, sells off, trades into our imbalance, digs in to the lower end, which is the, what is that? The opening price on the down close candle on the daily chart, which is the bullish order block. This is the high of the daily bullish order block. Okay, so that way, go back through this video a couple times. I promise I won't go too long with it, but this level is the opening price on the daily chart, down candle, at the beginning of the discussion for NASDAQ. We trade down into it, taking out sell side here, and then trades higher, trades back down into a fair value gap after sell side's been taken, and a higher time frame order block has been traded to. The market rallies, trades above a short-term high, so now we have a shift in market structure. Fair value gap here, trades down into consequent encroachment between the candles low and the candles high here. Midpoint is here, and we have a bullish breaker. So we have low, high, lower low, take the body of the candle, most uppermost candle, extend it forward. Okay, you're doing it with the up close candle, not the down close candle when you're using bullish breakers. Extend it through. You can see we're finding some support in here, consequent encroachment, and you want to see gaps like that in this stay open. It would promote the idea that you may be seeing a breakaway gap. Market rallies back up into last up close candle. This would be a breaker by any other definition, but because we are elongated from that high, in other words, it keeps stretching further. When we trade back to it and above it, it's mitigation. Okay, so what's being mitigated here? Any trader that's offside that was going long in here, they can mitigate that trade here. Order blocks and candles are not mitigating. Okay, I see a lot of people using the word a lot, excessively. Mitigation and mitigating is the action of the trader that is offside. Order blocks and candles are not mitigating anything. Price is allowing the trader to mitigate their offside position, mitigating potential drawdown, limiting it or removing it altogether. So that was the function of mitigation. Trades down until here. Also, we have a buy side imbalance, sell side inefficiency. This candle's high, this candle's low. We dip into that partially. It's supporting. Why didn't it all the way come down to this level here? Because of the mitigation block. Leave some of that open. Expect it to be institutional order flow entry drill, which is a partial entry to a fair value gap before resuming higher. The market reaches up into the buy side liquidity here, creates a bullish order block, trades down into here, rallies, fair value gap, consolidates, accumulates more long positions, and then rallies away. What level is this accumulating longs at? At the high of the daily bullish order block wick. And down here is the daily order block opening price. So this is the high wick area of it. And then we have market rally up, order block retest here, and continues to move higher. Afternoon session on NASDAQ, dropping into still the 2-minute chart. New York lunch begins and ends. Here's that run from the order block, and then the fair value gap rallying around the high of that daily bullish order block, wick high. Rallies, order block, as I mentioned before we transitioned into the PM session slide here. Another institutional order flow entry drill right there. I don't have that noted, I apologize. Fair value gap with an order block, trades into it here, rallies, order block cut through candles, folks. Bullish order block rallies, another order block, 1, 2, 3. Why do I only use this one candle here, and why do I use all of these here? Because all of these candles here are going against order flow. Order flow is bullish. So if there's a series of down close candles and we rally through it strongly like we do here, go back to that original high candle, extend it forward. We have an imbalance, yes. We have a potential order block here, but I'm not interested in that one. Why? Because the candle's body on this one goes lower than that one. There's rules, there's levels to all this, folks. The market drops into the order block, accumulates, rallies again, small little fair value gap in here between this candle's high and this candle's low, extend it through, accumulates longs here, 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 and then once more over here. Why? Because it needs to go higher. In that last hour trading, the macro runs from 3 o'clock to 4 o'clock, trades down to the order block. Everyone thinks the high's in place, pumps it through, clears out buy side. Rolling on over into E-mini S&P. This is our daily chart. Obviously, this high is important. I just don't have it on the chart because I want you to see the distinctions between these levels. We have the consequent encroachment of this wick, 41.17 3/4. Consequent encroachment of this candle's wick, which is 4,072.75. Much like NASDAQ, we had accumulation from this original fair value gap here, bouncing, trading up to and stopping here. Most traders, like I mentioned, they would expect this to be a sell-off. The market does in fact deliver that. Then we had this move here. Okay. Previous day, we had this small little candle, which is what? An inside day. Inside day because its high is lower than the previous day and its low is higher than the previous day. So we're going to get a large range day whenever we see this type of scenario. Now, I like the idea that we came all the way back down into this buy side imbalance, sell side inefficiency, this green candle here. And the buy side imbalance, sell side inefficiency fair value gap is framed with this candle's high, this candle's low. Split this candle's range between here and here. This is consequent encroachment. Look how nicely, it's beautiful. It's almost like poetry. How it just drops like this, hits the consequent encroachment, completely algorithmic, and then reprices higher. Now, intraday, this is going to look like it's going to hell. Oh, it's going to crash. Oh, it's going to, And so it feels like when you're watching these lower time frames, but you have to have a baseline on what the higher time frame daily chart is, because the algorithm is predominantly using reference points on this time frame here. So narrative is really closely linked to this time frame. So you need to know your key levels off of this daily chart. Carrying those ideas and levels over into the hourly chart, you can see here, here's that buy side imbalance, sell side inefficiency, and the market rallied up on the pass through here, consolidated, relative equal lows. So you know what's going to be resting below that, right? Sell side liquidity. And we had a small little imbalance that's purple. It's hard to see it, I know. Then we have this one here, and then we have this one down here. It's better to leave this one open. Why? This is the part where you write down in your notebook. When you have a larger imbalance like this blue shaded one here from the daily chart, if I'm bullish, I want to see the majority of the reactions in the upper portion, which would be the premium level of the imbalance. But when you're looking for continuations, don't see this trading down to this level here in the upper portion, like I have here, the upper half of the fair value gap. That area here, a premium on a higher time frame level when bullish, when it trades back down into it, it creates what? An inversion. So premium becomes discount. That part is extremely confusing. You want to know the answers to why I know some of these imbalances are going to stay open, right? Well, I'm teaching it to you. The whole point is there are some imbalances that are going to remain open. Some, I want them filled. The ones in the upper half of this fair value gap on the daily chart, above consequent encroachment, I want to see those filled. It's even stronger if they don't fill in. But the ones on the lower half, they are likely to stay open. They're better to stay open. If they come down and fill in, then it's not as bullish. And the algorithm may chop around and consolidate longer, and then I have to wait for more information. But if I see these types of scenarios here, it's almost like a loaded deal, like a lead pipe cinch trade. It's just easy. Like it's a sledgehammer. Like it's pretty much next to a sure thing that you're going to get a type of reaction like this here. Okay. And that's why sometimes when you see me trade, I can go right in there when it's just driving straight down like a falling dagger, and I'll catch it right when it's going into the lowest low, and I'll buy it right there. which seems crazy, but it's these types of scenarios that I do that in, when I can see what the framework is and trust that these areas down here won't be traded too. So we have an imbalance in here. Keep your eye on that pink area there. And then we have this wick as a consequent encroachment. That's the next objective at 4,043.25. And the rejection block, we saw that traded to today, 4038.75. And let's dig into the perspective of this entire range from here to here. Here's equilibrium. So we are in what? A discount. So even though we're in the upper portion of that daily fair value gap in the form of a buy side imbalance, sell side inefficiency, that's that blue shaded box here. The upper portion of that is the ideal scenario for what? Lower intraday charts trading down into that, creating a discount relative to this low to this high. So you can start to see how this web gets very, very intricate as we drop from a higher time frame down to the lower time frame. And if you don't know your stuff, or more specifically, my stuff, you can get easily inundated and lost, which is why algorithmic theory must be understood. You just can't look at down close candles and think they're order blocks, and you can't look at just every individual candle that may resemble a fair value gap and assume that you're going to have a trade on that. There has to be narrative wrapped around it. Okay, 15-minute time frame. You can see that we dropped down from the fair value gap over here. We went below the low here. Went below, it came back up. Look how it's really respecting that. One more time here, consequent encroachment, midpoint of the pink shaded area. And then it acts as what? Real resistance. As it acted support here, right? If we go through it, like we do here, it can come back up. And then what? We start to work down. This whole shaded area becomes what? A balanced price range. It's delivered both sides. Down, up, and then left it. Come back in. Consequent encroachment. That's the last line of defense. And goodbye. Next T plunge. Drops lower, creates a small little SIBI here. Fair value gap. Consequent encroachment. Beautiful delivery down into our lower level hourly fair value gap. Digs into it perfectly here. Well, not perfectly. It went over by 1/4 of a point. So one tick. Then we consolidate here. Create a fair value gap, as I mentioned, live on the 1-minute chart. And then rallied up. So notice also this SIBI, project that through. And you can see we come back down into it and consequent encroachment once more. Bam! The rally's up. Takes out buy side here. Digs into the last up close, little change in the state of delivery here. Let's drop into the 5-minute chart. Okay, here's the 5-minute chart. Sell side liquidity here, digs below it, hits the hourly fair value gap, the one at consequent encroachment. Remember, we don't want to see the lower half of that daily buy side imbalance, sell side inefficiency, which is that big blue shaded area here. We don't want to see it trade down below consequent encroachment. We're focusing on the upper portion of that. Because if it's going to do its turn in here and start presenting all these arrays that we can time off a long or a shift higher in price, then it's better for it to do that there than to dig into the lower portion of that buy side imbalance, sell side efficiency on the daily chart. Now, this is one of those videos where you have to watch it a few times, because what I'm saying isn't going to register until you watch the first portion of the video that I've said so far pertaining to ES, because it takes a couple times to see where we're at in the lower time frames, what these areas are, and you can quickly see why I'm not painting all this stuff on my charts when I'm watching it, because to me this is extremely busy, but I'm showing you the overlap of all of these convergences that the algorithm is going to refer to. It's not supply and demand, and it's not support and resistance. It's these ranges that the market's going to key off of. Very specific prices. The high, the middle point, or the low. And there's logic into knowing which one you want to see hit and which ones you don't want to see hit. But I want you to take your attention in here. We have this candle here. this candle here, and then this candle right there. See that? So the market reacts from the low end of the hourly fair value gap that joins and links with the consequent encroachment of that daily buy-side imbalance, sell-side inefficiency, the blue rectangle. It rallies up, creates a short-term high right there. And then this candle pierces it, creating, when this candle here closes, fair value gap right there. See that? So the market trades down into it here. Once more opens and then runs away. Order block, trades down, retouches it, rallies, consolidates, rallies again into our old shaded area, dips back down. It's going to be resistance here. No, we have now turned the corner down here. The bearish sentiment is no longer valid. We would be considering what? The end of bearish sentiment is now bullish. And in here, I give a very specific candle to talk about a fair value gap, and we'll look at that when we drop down in lower time frames, but it rallies away and comes back down into the buy side of sell side efficiency here with the order block, trades to it there, rallies through, and presses into the afternoon 4038.75 level. On the 1 minute chart, you can see how we dropped from that 15-minute time frame fair value gap. We traded up into it here. This is a Judas swing after taking buy side liquidity. This right here had everybody thinking it's going to rip higher. I was watching several live streamers this morning. They got really animated here. They were actually wishing and cheerleading, hoping it goes higher, hoping it goes higher. And the more they did that, the more I felt confident that it was going to sell off. So I actually sold off a position here, built it larger here, and wrote it all the way down into this level here. And then in here, I went short, building up another position. The market did, in fact, rally here. Look at this high here, right where the volume imbalance is. See this high here? This candle's high is higher than that one. And then this candle is lower than that one. This is your swing high. The market rallies through. That's a shift in market structure. But ICT, it didn't close above that high. I didn't say it had to. Go back and watch the videos on the 2022 model. A shift in market structure does not ever require a close above a short-term high when it's shifting bullish. It does not require a close below the swing low when it's shifting bearish. So that shift here is bullish. So this drop down here, it's a suspect decline. It's a Judas swing in many ways. Where's it going? Fair value gap. Trades in consequent encroachment, midpoint. How nice is that? The market rallies, takes out the short-term high here, another fair value gap. Here's where I stated, look at that candle right there on a 1 minute chart. That candle is your fair value gap. And I said, you had homework today. I gave you a task of looking for find two 5-handle price runs before noon. Well, I know some of you were not able to get 2, so I gave you one today. Here is the candle. That range extended through. It touches it here, 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 here. And then I said, you want to take your attention to 39.82 buy side liquidity, which is this short-term high. Why that one? Because it's going to offer 5 handles. Easy. And it delivers like gangbusters. We consolidated in here, ripped through, took the buy side here, back into that imbalance on the hourly chart. An hourly break of continuity in price action during the New York lunch hour. You can see that here. We drop back down into the buy side imbalance, sell side efficiency, hits the order block here. Beautiful rally. Accumulates at the low end of that old hourly imbalance, the pink shaded area, and fair value gap. Rallies once more. And you're going to want to go through your charts and see what these levels are. So there's no excuse, zero excuse for you not to be going into your charts, because if you don't do that, you're not going to get the blue ribbon results you're hoping for at the end. Market creates a decline in here. Order block. Trades into it here, rips higher. Fair value gap, digs into it here with an order block. Rallies again, buy side taken, Here, false high, drops back down the last hour of trading between 3 o'clock and 4 o'clock. Order block, extended through. Why this one? Because we're not supply and demand, we cut through candles. This is the most significant price point. This one here. Last two down closed candles. Through this price action, hits it here. Last hour macro comes in right when you're expecting it to. Rallies up, takes the buy side out. Bam! Hits the 40.38 and 3/4 level. Go back to the beginning of the discussion for ES and see what that is on the daily chart. That's where you derive it from.